What's up, Gould Miners? Today we welcome Kevin Dean to the show. Kevin is the managing partner at Rockbridge Investment Group. They have 23 multifamily properties and over 3,100 doors. Oh, and did I mention Kevin's only 29 years old? Kevin started his real estate investing journey fresh out of college while also working a 9-to-5 at the same time. And early on in the episode, we talk about how he was able to get started and grow a portfolio so quickly at such a young age. Later on in the episode, we talk about some of the secrets to his success, both as an asset manager and as a capital raiser. Kevin really goes deep here and talks about some of the unscalable strategies that he uses to scale his real estate investment group. And finally, we end the episode actually by going back in time and talking about his first partnership and some of the things that Kevin would recommend for anyone who is looking for either a partner or a mentor to start their investing journey with. He really spends some time going over some of the questions and some of the things that you should be thinking about before agreeing to partner with anyone as a real estate investor. Kevin is such a relatable guy and incredibly humble, especially for the amount of success that he has managed to have at such a young age. And I can't wait for all of you to really dig in and listen to some of these nuggets that he has to share. So without further ado, everyone, let's welcome to the show, Kevin Dean. Kevin, welcome to the Gould Mine.
Excited to be here. Thanks for having me, Danny.
Yeah, man, this is great. And we're just chatting about golf a little bit before we started. Maybe we'll get there towards the end because I'm sure some of our listeners enjoy a good round of golf. But before you got into real estate, you were working a full 9-to-5, and there's probably some listeners back at home who are kind of trying to figure out like, how do I make that transition? And so how did you initially balance the two, working 9-to-5, also full-time or investing probably full-time hours into your investing career? And then how did you break free of that?
Yeah, it's a good conversation. I think a lot of people either wait too long or don't wait long enough, and then you end up causing unforeseen issues with your business. So I think it's definitely like something you want to be really strategic about. But I don't think enough people give credit to people who are working the 9-to-5 and also, have the side hustle going. I think that, when you have a W-2 paycheck, as long as you're not, especially, as long as it's reasonable and manageable, it can keep you from forcing deals, right? Where if you leave your job and then you feel like you need to get deals done because you no longer have the steady paycheck, can force you to make bad decisions. So yeah, with that being said, I started Rockbridge back in 2018 and I had graduated college in 2017. So I was about a year in, quickly realized I was on the wrong side of the table and I wanted to get onto the ownership side of the business. But I had to build up the savings and build the business out and really learn a ton before I made that jump. So what I did was, I was working a pretty intense job. It was kind of like a capital markets bond trading type job. So basically from like 8 till 5:30, it was just work. None of the side hustle Rockbridge type stuff. So basically, before work, I would be on the phone, sending emails, text messages, that sort of thing. And then on my commute home, I had a long commute. I'd call brokers, call potential investors, potential partners, listen to podcasts, that sort of thing. And it was really just about like making the most of being young, not having kids yet, not being married yet, and just grinding for a while until, it made sense to make the jump. So it's definitely a balancing act, but I think, depending on the stage of life you're in, there's different ways to go about it, I guess is what I would say.
Yeah, so you're super young then. How old are you today?
Yeah, I'm 29. So
wow, that's incredible. I didn't even. So what's funny is that you don't. I mean, you look young, but and you have a youthful energy, but like you talk like someone who's been doing this for like a very, very long time. And so that I didn't even. I thought you were kind of like in your like mid to late 30s. That's interesting. Wow. So that really begs the question for me because, there's a lot of investors who kind of get started early and I'm sure that you ran up against the age conversation a lot when you were starting, right? People not taking you seriously, people doubting your ability to close, sellers doubting your ability to close, brokers doubting your ability to like bring money to the table. So how did you go about kind of maneuvering or getting around those hurdles, right? Like specifically when you were like fresh out, like those first couple of years, I'm sure after you built the track record spoke for itself. But when you were first starting, there was definitely some resistance, I'm imagining.
There was probably less than you think, to be honest with you. I think a lot of times people try to use their age either as like a crutch or like a benefit. And I don't think it's as important as people think. So I think there's a lot of young guys out there who like want to tout the, hey, I'm young and look at me. Or, hey, I'm young, people won't take me seriously. And I think that for me, just learning as much as I possibly could as quickly as possible. And then also just being very honest about what I do and don't know and the track record I do and don't have. I was aiming to establish rapport with investors and brokers and that kind of thing. So there wasn't any like fake it till you make it mentality. It was more just like, hey, here's who I am. Here's what I know. Here's what I don't know. And then just doing what you say you're going to do, but also not over promising. Right. So, I had many conversations with sellers that would start off really well. And, we're on the phone, so they can't see how young I am. And it's easier to establish rapport. And then once we start digging into, hey, what's your track record? What's your background? That's when the tough questions come up. And I never tried to act like I was somebody who I wasn't. So, getting started, I relied on partners a ton because I really didn't have the balance sheet, the track record, the investor network. And I was very clear about that, with brokers and sellers and investors and whoever I was talking to. And then obviously over time, it morphed into being able to take all that stuff in house and really being able to do more. But when I was first getting started, I think a lot of the people who were older in the business saw somebody younger and they actually wanted to help me out more than they would have otherwise. So that was a big thing. And then the other thing is with the younger brokers and people, lenders, whoever, who are around the same age as me, they saw the opportunity to kind of grow together where it's like, hey, we're doing this for a long time. God willing, we'll be in business together. So that also was helpful. So I really didn't see it as a negative at all.
Yeah. And I'm sure, and you're right. There's a lot of people who are kind of like the vendors, the ancillary services, everything. There's a lot of people that see that youthful energy and they want to latch onto it because they're like, dude, I could grow with this person for decades. If they're smart, they kind of understand that. So that makes perfect sense to me. The other thing too is like, it sounds like you had a really good mindset going into your, investing journey. And you're right. Some people will look at whatever their skill set is, situation is, and they'll say, this is the reason why I'm going to succeed, or this is the reason why I'm going to fail. And you get to decide, right? That's kind of what I heard is you either make it a crutch or you make it a benefit to you. You obviously had a lot of time on your hands because you were younger and everything. And you alluded to that earlier, but I'm curious, what do you think some of the benefits are of getting into real estate investing so young, right? Like what are some of the other benefits that these listeners back at home can listen to? So like, okay, well that check that box, check that box, check that box outside of the time aspect.
Yeah, I think a lot of things. I mean, I definitely see a lot of people who know a lot more than I do and have a lot more experience, maybe coming from like a commercial real estate background. And then they want to branch off and start their own business, later in life. And I think the upside there is, a ton. The downside is you feel like you need to squeeze a lot into a small time frame. And it's almost like your time horizon is maybe 10 years or 15 years. So the way you structure your business plan for your, real estate assets or your acquisition strategy or whatever it may be, it might not be what's best for your business, but it fits your specific timeline, right? So I think the benefit of getting started earlier is you have the ability to stay flexible with those timelines. Perfect example would be, hey, I want to acquire $150 million of real estate and, I want to do that in the next like 5 to 7 years. So then I can then execute on the business plan, sell, and then retire when I'm 70 years old.
Yep.
If you're younger, that 5 to 7 years can be 10 to 20 years. And you don't necessarily need to do deals just for the sake of getting deals done. You can really afford to be a lot more choosy about things. So I think that's one of the massive benefits of getting started younger, as long as you don't feel like you have anything to prove, which I think, that can be an issue too. But you don't feel like you have anything to prove and you need to just go out and be the biggest and the best, you have a lot of your time on your hand to make good decisions. So that's a huge benefit. And then obviously the time value of money, the sooner you get started, the better.
So you don't think having a chip on your shoulder is a benefit then?
I think it can be a benefit for inspiring you to work really hard, but I don't think having a chip on your shoulder is good for making good financial decisions. I think it can help you exercise your risk muscle better than you would have otherwise if there is some sort of time crunch or chip on your shoulder or you have something to prove. But I know for me personally, when I've been in the situation where it's like, I need to win this deal because I want to win this deal, that's when you start, maybe pencil whipping the deal a little bit more and stretching the underwriting here, counting on best case scenarios. So I think it can be good for certain things but can also introduce risk, on the other side.
Yeah, it's interesting. And you even said this earlier, right? Like you had a 9 to 5. And so you didn't do deals just for the sake of doing deals, where sometimes people make this their full-time career. And then all of a sudden they need to get the deal done or they're broke, right? And so that makes perfect sense to me. I also have heard other people say like, hey, you got to act with a sense of urgency. You got to act with a sense of urgency. So how do you balance that, right? Like, how do you act with a sense of urgency, yet still stay patient enough to like not do deals just for the sake of doing deals?
Yeah. So the way we look at it is like, we want to be extremely aggressive on bringing deals into the funnel. And then once they're in the funnel, that's when we get really concerned. So like the default is to be as aggressive as possible and like sourcing those opportunities, underwriting as many deals as possible, making the phone call that you don't feel like making. And then once you get it into the pipeline, then that's when you go really deep and because you have so many deals you're looking at, you can afford to be more choosy. So if you're only underwriting 5 deals a month, right, you're probably going to get a little bit more aggressive. Whereas if you have this massive deal funnel where you're just looking at so many deals and it's more of like an abundance mentality where you're like, hey, if this one doesn't work, I have another 8 that I need to underwrite by Friday anyways. I'm sure one of them will look better than this. That's how I would say we balance that.
That makes a lot of sense to me. So, and by the way, like, it's just math, right? So like the more opportunities you have, the more full your pipeline is, statistically speaking, the better deals you're going to do, right?
Completely agree.
Like if you have more to choose from. So that makes perfect sense to me. And I like that frame of mind, right? It's like, hey, act urgent in the gathering, right? But then be super diligent on the analysis and the underwriting. That makes sense to me. How are you managing the acquisitions and the deal sourcing, right? So how do you structure your day-to-day managing all of that, managing the systems? I'm sure that you've got other team members and stuff that are kind of like working those systems and everything, but then also looking after looking after the assets, managing the assets, that sort of thing, right? How are you balancing filling the funnel, but then also taking care of what you got?
Yeah, that's a great question. And probably not like a one-word answer, but I would say, we only try to grow as fast as we can grow while still executing on the business plans for the deals we've already bought. So like the first priority for our business is always taking care of what we already have, right? In the beginning, it was way more about, we need to get deals under contract. We need to close deals. We need to underwrite deals. We underwrote 420 deals last year. We bought 1. So we're still underwriting and looking at a ton of deals. But the first priority, of course, is managing what you already have, not only like the assets, but also the relationships you have with your investors. Because for us, like it takes so much time to find a great deal. It takes so much time to find a great investor who trusts you and will actually put their hard-earned money into your investment opportunity. So once we have that, like we want to treat it like gold. Right. That, takes a lot of time from like a, systems and processes standpoint of like actually managing the assets, but then also on the investor side, calling investors just randomly to check in, shooting them a text when you're on site with a property and letting them know, hey, this is going really well. So that does definitely take time. And I would say for us, we can get as like into the weeds as you want on it. We definitely lean into the tech side of the business because we have a pretty small team, and our goal is to basically manage our assets super efficiently with as little amount of people as possible. And again, it goes back to the thought process of, hey, if you have to do the next deal, you're going to end up doing not as great deals, right? And I think if you grow your team too fast, and your overhead gets really high, you've got, maybe a mortgage on an office building you bought or whatever it may be, and then payroll, et cetera. Yes, you have the machine rolling to where you're probably going to find more deals if you have a bigger team, right? But it's also about like matching. Okay, we want to grow as we need to grow, but we don't want to grow our team so fast that we then are forced to do deals to pay for our overhead, right? So like with that being said, we've been very strategic about, okay, what tech are we using across the various, divisions of our company to make sure we're able to manage things effectively.
So let's talk about the structure there then, right, at Rockbridge. And you've got 3,100 doors, correct? Is that more or less? Okay, so we got 3,100 doors and you've got a small team, you said. So like, what does the infrastructure look like right now at Rockbridge?
So one of the benefits is the first dozen deals we actually did through a joint venture partnership where, we were getting started. So we weren't able to raise capital. We weren't able to sign on debt. So we found a great partner who we were able to work with, who was able to bring some stuff to the table that we weren't able to bring. And we really focused more on like the acquisitions and the finance side of the business. And over time, we've been able to add value on all those things with them. But what that enabled us to do was keep the team really light to just 3 people essentially, for the first, call it 12 deals we did. And that's about half of our portfolio. So since then, we've started doing our own deals. We're still open to joint venture partnerships if it makes sense, on certain deals. But for the most part, we're leading everything on the deal. And with that being said, for our company, we've got 3 partners, right? One who oversees all sort of finance, CFO. He's our CFO functions, but he also helps out with asset management because that kind of connects to the finance side of the business. One partner who oversees essentially acquisitions and asset management. And then I kind of span across all the different divisions from like capital raising, asset management, acquisitions, CFO, where I'm not as in the weeds on each individual thing per se, but, still have my hand in a little bit of that. And eventually that will probably change, but where we're at right now, in kind of growth mode, the 3 partners are still in the weeds on everything. And then we also have a sort of bookkeeper controller, who helps a lot with the CFO type stuff, investor distributions, making sure invoices paid, that kind of thing. And then we have another woman who helps out with sort of asset management, marketing, operations type tasks. So all in all, not including our on-site teams, the actual corporate structure is just 5 people.
Nice. Yeah. And that's big enough to manage 3,100 doors. So what I'm hearing then is like, it really doesn't take a massive team to manage that, that much real estate, as long as you've got your system set up properly. And, I think it's smart, especially with the way things are right now with the economy, to keep things as light as possible, right? Because you never know when things are going to shift or whatever. And so it sounds like you guys were well equipped then to kind of handle the storm. How have you been dealing with all of this stuff? The last year and a half, 2 years, the turbulence in the market. You said last year you underwrote 420 deals. You picked up 1. Obviously, that's a testament, right, to how difficult it was to just make deals happen, or it has been to make deals happen in like the last couple of years. So how have you weathered that storm? And do you see that the structure of your team is kind of like light and agile enough to kind of avoid the issues that a lot of other, funds and whatnot kind of had to go through over the last couple of years?
Yeah. So we acquired 1 deal last year. Luckily this year so far we've acquired 4 deals, which has been great. So a lot of the deals we underwrote last year that didn't work out, are actually coming to fruition this year, which is amazing. But it was definitely a lot of spinning your wheels and not getting, new opportunities under contract. The way we've been thinking about it over the last 2 years is you kind of have to segment your mind and say, okay, we've got our existing portfolio, like what needs attention, what could potentially be an issue. And if there are any issues, like what are we doing there? And then on the flip side, recognizing that there are tons of opportunities right now. There's a lot of people who are afraid to take action and actually get deals under contract. So like, we want to make sure we take advantage of that, right? So, you know, we're not immune to the issues that other people have had with rising interest rates. We've had a few deals that we've put floating rate debt on where we've had to buy new interest rate caps, you know, size new refinances every single month and just kind of plan ahead. So far we're doing okay. We haven't had to do any capital calls at all. We haven't had to sell any assets. We haven't had any refinances that were unplanned, that were forced. So for now, we're managing everything just fine. There are certain deals that are not performing as well as we thought they were because the interest payment has gone up significantly on that deal, and we've hit our interest rate caps, which we didn't think we would. So, we're not immune to any of the challenges that people have had. I think we've definitely fared better than a lot of people we've heard. But in hindsight, obviously we've learned a ton about floating rate debt versus fixed rate debt, how you're using interest rate caps, how much operating reserves you have, that sort of thing. But I guess like the high level answer to your question is, looking at it, segmenting it in your mind, dealing with your existing issues, but not letting that cause fear and cause you to get stuck and actually still being aggressive on the acquisition side. Cause we have found the 4 deals we've closed on this year have been amazing opportunities, and we would not have been able to acquire any of these for the prices that we're buying them at just 2 years ago. So
yeah, and that you said something super interesting there that I want to spend some time on. So some of the deals that you found then, or some of the deals that you've closed on this year were actually deals that you found last year. Sounds like you may have even, kind of walk me through that, like, because I know that a lot of people are doing this right now, are kind of going through this where sellers are coming back to them. Maybe they made an offer like 6 months ago, 12 months ago, or they were talking to the broker 6 months ago, 12 months ago. And now the broker's kind of coming back and being like, hey, are you guys still interested? Is that more or less what happened to you on some of these deals?
Yeah. I think for 2 of them, that's the case. The other 2, it was actually more, deals that were either being shopped off market, or they were marketed and they either fell out of contract, or the asking price was way too high. So a lot of people just looked at the deal and said, we're not going to pay that. And they didn't even underwrite it. We said, hey, asking price is, 33 million. We think it's worth 23 million. Let's just submit at 23 and see what happens. Right. We've had a few opportunities like that where, brokers are doing the absolute best they can because it's really tough for them. And sometimes sellers want a certain price and they need to kind of go out and see if they can get it. But at the end of the day, their mission is to execute and sell the deal. They're not going to get paid if they don't. So sometimes these deals do work out where the asking price is unreasonably high. And if you kind of just stay in the game long enough, it ends up coming your way, even if you're at 70% of asking price.
Yeah. So it's definitely important to be in the game right now. And I think that a lot of people are scared to even enter the market. So it's good to hear that you feel the same way, right? Like we got to stay aggressive in our deal sourcing right now, especially over the next 12, 18 months, while so many people sit on the sidelines, yet so many sellers are in some form of distress. I mean, it's not rocket science, right? When everyone else goes left, you go right. Seems to work pretty well for the people that do that in real estate investing. So Kevin, why do you think that is, man? Like, why do you think so many people, like, they know what the recipe for success is? It's history, right? It repeats itself over and over and over again. It's like, look at the financial crisis. Look at what happened in 08, 09, when everyone was hurting. The big institutions, the guys that made billions of dollars came in, bought all that real estate. And now we're kind of going through the same thing all over again, but people just don't get it. They're like afraid to, like, why is that? I don't get it.
I mean, I think it's definitely easier said than done. And numerous times we've won deals and we say, oh gosh, where did we mess up? Right? Because when you're the one who pays the most, you inherently think that you made a mistake, right? Everybody likes to sell, well, we've got this relationship. And like, sometimes that's the case. Like, we've got a deal right now that it's purely a relationship deal. We're buying it significantly lower than what other offers have come in at, but that's pretty rare.
Yeah.
most of the time you just pay more than everybody else, right?
Right.
So I think that when you're in a time like right now, it's especially when you are working at another company. So you think about like all these acquisitions guys who work at this huge company. They're not getting like a giant promote probably if they buy this deal. But if they recommend buying a deal and it goes bad and everybody else is not buying deals, then they're going to get fired, right? So it's like the upside of getting aggressive and sticking your neck out a little bit doesn't really compare to the downside if you stick your neck out and you're wrong, right? And I think that's how a lot of people think about it. So they wait for like Blackstone to enter the market again to get the all clear sign, and they say, all right, Blackstone's back in. They're very smart. If they're going in on deals, then we should get aggressive again. Well, then all of a sudden you're competing against everybody again. And then, you got hard money day one. You're in a bidding war. So I definitely think it's easier said than done to get, it's like that saying from Warren Buffett, be greedy when others are fearful and fearful when others are greedy. It's a lot easier. It makes sense. But when you're in it and you're afraid of being wrong, and especially when you're dealing with other people's money, I totally understand why they default to just seeing what everybody else is going to do and waiting until they get the all clear sign before they pull the trigger.
Yeah, there's definitely, I see both sides of it. It's just, there's been so many times in history where this has happened to the point where it feels like almost like common sense, right? To go and do the thing when everyone else is shying away from it. But again, I think that's what makes guys like you, guys like myself, more dangerous, is because we have the ability to see that. And while others see it, we act on it. And that's the difference.
I think the other part of that too is whether or not you have the capital to actually do it. Because if you're dealing with a portfolio that's not doing well, and then you're going to go ask the same investors to invest with you on this new opportunity when you don't have the all clear sign yet, it's a lot more difficult to have confidence and put that deal under contract. So I think like it also ties into having great investor relationships and making sure that you're keeping your investors updated. You understand like where they're at in terms of their appetite to invest. Because if you believe in an investment thesis and you believe it makes sense to buy right now, but you're not really sure if you can fund it, you're not going to do it. Right. Right. So I think we're far with it.
100%. And that begs the question, right? So how did you go about cultivating those relationships? Because now you've got a track record, right? So I'm sure that you have some repeat investors, guys that come back to the table. How did you initially create those relationships? And then what have you done to, obviously outside of like, obviously you guys have been doing a good job for them, but what strategies have you used to kind of like keep them engaged and keep them coming back and reinvesting in your future deals?
Yeah. The number one thing for getting repeat investors is just doing what you say you're going to do. So delivering K1s on time, is like one of the most underrated things ever, because, investors don't think about it until it's late and they have to delay their taxes. So that's like an easy one, like making sure if you say we're going to send out a communication on the 25th of the month, every single month, you do it by the 25th of the month. There's no excuses for sending it on the 26th. Right. And then same thing with the actual returns. Like you say you're going to pay 7% by year 2 and you're at 5.2%, as long, I really do believe as long as you're communicating and there's a reason for it, it's okay. But ideally you can meet investor expectations based on what you originally promised and projected in your underwriting. So I think that's a big thing. And then in terms of like actually building those investor relationships, start with, for us, we have not done it in a very scalable way. I think a lot of groups, and I'm not against this at all, are big on like sending out automated text messages and email marketing and mailing campaigns. I'm not opposed to that at all. I don't know much about that. We have not gone about it that way. For us, what we've done is it's been not as scalable. It's just been literally like one-on-one meetings, coffee, lunch, dinner, stuff like that, going golfing with investors. Our largest investor I actually met at the gym, and he has a bourbon night like once every 2 weeks at his house. And I just started going to that, 10 years ago when I was in like college. And basically, over time, turns out he wants to invest in real estate. We're now friends. Now he invests in every single one of our deals. He's by far our largest investor, and he's just somebody I met at the gym, doing bicep curls. So
that's so cool, man. And I think that kind of speaks to the idea that like you never really know how, when, and where you're going to meet your next investor. And so, having your antenna up all the time and it really makes a big difference. Obviously, like it takes 2 seconds for me to kind of gather, Kevin, that you're like a super personable dude, right? So I'm sure that you have no problem making friends, even in the wild, right? When like you don't even know who they are and doing curls. But it's important, right? It's like important to be able to like have those conversations. And I would imagine that, that kind of reminds me of a quote. I don't know if you follow Gary Vee at all. I used to watch a lot of his stuff. I don't really do anymore, but used to say this thing is like, hey, like I want to scale the unscalable, right? Like scale the unscalable, kind of this idea where, like unscalable things help you scale very nicely. And so I think it's important, right? Like, okay, yeah, you do the automated and you do you kind of check all those like marketing boxes, but at the end of the day, marketing doesn't really build relationships, right? So I think that's something that I'm just taking away right now is like, hey, like you can have you have the best marketing in the world, but if you're not putting in the effort to really get to know your people, you're probably not going to have as much success, A, or B, the success that you have is going to be limited, because I would imagine your average check size is probably a lot higher than it would be if you just did the drip campaigns.
Yes. Yeah. I mean, from people I hear who are kind of in the industry for this space, average investments usually between 100 and 200, and we're, more than double that. So we get a lot of people who are writing, relatively larger checks, for sure. And I love the point on the Gary Vee point. I am definitely a fan of him. And I think, somebody who he reminds me too of with that mentality is Andy Frisella. He talks about, he's got a whole in-house team where if they have issues, like it's not being outsourced to another country, they're writing handwritten notes and they're calling you directly. And that just creates that loyalty with your clientele that you can't replace with an email marketing campaign. So like some very practical things we do, after we close a deal, people get enough backpacks and pens and booklets to where they just throw them in the trash. So what we've come to is like, one, we want to do investor events on site at the property 6 months after we close so they can see the progress that we've made and also get to meet other investors, see us, that kind of thing. But 2 other easy things we do after we close a deal, we write handwritten thank you notes to our investors to let them know we're thankful for your hard-earned dollar being invested in our deal. We're going to do everything we possibly can to execute and protect your capital and grow it. And then we block out a day after closing, usually a week or 2 after, to just call every single investor individually and thank them. So it's such a small thing that typically leads to more referrals, more repeat investors. And, even when a deal goes not as according to plan, deal goes sideways, you're able to pick up the phone and call that investor and give them a heads up before you just put it into a marketing communication, in your investor portal, because you actually have a relationship and you know them. And it's investing. So everything's not going to go perfect, right? And our investors know that. These are just some of the practical things we do that are definitely not scalable.
Yeah. And I'm so glad to hear that my intuition was at least somewhat right. Like I had to have imagined that like your check sizes were a lot higher just hearing what you said. And so I guess that begs the question though, right? Because obviously you're a big thinker, you're thinking long term, right? So like I don't know if you've given any thought, right? Like how does that translate at a larger scale? Like are we look at that. And the lights just keep going out on me, dude. There it goes again. I'm just going to keep talking. It might eventually come back on. Who knows? But future plans, right? So how does Rockbridge scale this in the future? Are you bringing on more people, associates, then they man the personal relationships? Are you how would you, obviously, I'm not going to hold you to this, but I'm wondering if you've given any thought.
Yeah. We just had a partner meeting last week, actually, where, of course, we played a bunch of golf. But we were discussing this exact topic. And kind of the thought process for us is we definitely want to we want to continue to grow, right? But we don't need to be the biggest company in the world. So for us, if we can do 2 to 4 great deals a year, 1 a quarter, which is basically what we've averaged, that's an amazing business. And we'd rather do like less deals, but to have them be very high quality, right? So with that being said, we don't need to build out a 50-man, team. It doesn't need to be more than, maybe a dozen people over time to manage this portfolio. Sure. And then in terms of like making sure, all right, how are we growing, executing on the business plans, maintaining the assets well, all of that, but also keeping the personal touch. I think that there's certain things in the business that give us competitive advantage because we are the principals and we're actually the ones, we're the decision makers. So like, for example, when we're talking to a broker, one deal we're buying right now, I actually met the owner at a pizza restaurant and we struck up a conversation, ended up going to see his property, and then we negotiated the deal right there in a vacant unit, right? And because I'm the decision maker on the deal, I can build that relationship and actually speak from a position of authority rather than if it was, a new analyst who maybe doesn't have all the answers and he's going to have to run it through investment committee. Nothing against that, right. But there is a competitive advantage if you're able to do that, right? So things like 100%. That on the acquisition side, we want to make sure that like us as the partners are still heavily involved in. That doesn't mean we need to underwrite every single deal, but we want to make sure we have our finger on the pulse for every deal to where if we're, in the vacant unit with the owner, we can actually speak to the deal. And then same thing on the investor side, right? So tasks such as sending out investor distributions, putting together like a marketing piece, doing the monthly financial reporting that we send out, things like that. We don't necessarily need to be the ones doing it. But when it comes to communicating that one-on-one to our investors, we want to make sure that we're still involved. So I think it's like not outsourcing, but delegating the right things and then freeing yourself up to do the things that are maybe not as scalable, but are a way, higher dollar per hour type of task. That's kind of how we look at it.
Yeah, obviously that makes sense, right? Like you're going to delegate the things that are lower dollar producing and or require less skill, less aptitude, less whatever. Shifting gears here a little bit, Kevin, because I'm actually quite curious, and we totally skipped over this part, and that's just on me because I was like so excited to get into meat and potatoes. But like you were what, like 22, right, when you started, all right, and you found 23, I would imagine, kind of like in that age range. You found a partner to JV with. How did that come about, right? Because I'm sure that there's some young listeners right now that want to find a mentor, that want to find a partner, want to find someone to kind of coach them through their first couple of deals. How did you go about doing that? And then what did that first deal look like?
Yeah, great question. So the way I met that partner was I actually just cold called him off of a podcast. So he left his phone number at the end of the podcast. And
nice.
He was one of the maybe 20th or 30th person that I called, from a podcast or research and tried to find on LinkedIn. And we just hit it off. We connected on a lot of different levels. We share similar faith. We, have a lot of the same goals, same backgrounds. So we connected really well. And just said, hey, yeah, let's start looking at deals together. So that's how it happened. It's off of a podcast. And then the first deal we did together was actually, I had a few target markets that I was interested in that I thought made sense from an investment standpoint. And I kind of pitched those to that group. And then one of the markets that we had picked, I ended up finding a deal maybe 6 months after, starting to work together. It was a 166 unit apartment complex in Lexington, Kentucky. And, the deal penciled really well. I was able to present that to this partner, get it under LOI, and then we closed on that deal together. And then we ended up building a portfolio in that town together. So that was the first deal and kind of how it came about.
That's awesome. And obviously you hit it off, you share the same faith and everything, but like, I feel like there's also the risk of getting into a partnership where things look rosy and awesome at the beginning, and then it turns out to be not so great. So what advice would you give to someone that's looking for a mentor? Like, what are some of the, I would say, green flags and maybe some things to look out for in terms of like red flags?
Yeah, I feel like we could do a full podcast on this. I mean, I'll just spout out some things that come to mind. I think one, like you want to take your time, like getting to know that person, ideally get to know, if they're married, their spouse, and just understanding like who they are as a person. And then also understanding what do they want over the next 5 years? What do they want over the next 30 years? Right. And you don't have to know exactly what you want to do for the next 30 years, but it's good to just ask those questions up front and make sure before you forge something together, like you're putting something together that ideally will last for a very long time. Everything isn't going to last forever, but, if you're going into it with the thought process of, hey, we'll do like two to four deals together and then we'll form our own things, like you're going to be in trouble just from the start. I think another big thing is like making sure that you have an alignment of interest in the deals that you're putting together, the partnership that you're structuring. So like for me, one of the most important things is everybody wants to see people putting their own money into these deals. Signing on the debt is of course helpful, but for me, like the number one way to align interest, if you're putting together like a real estate syndication deal, for example, is do you actually have friends and family who are investing in the deal? Because if you're going out and you're raising money from like your father-in-law and then you're going to see him at Thanksgiving, you're going to be that much more inclined to make sure you're doing everything you possibly can to make sure that deal is successful. Right. So like, I think that is something that is very underrated. Like we've done, institutional equity deals. We've actually just done one, so I shouldn't say deals, and it was great. But like if you're going down the syndication route and you want to, I think a lot of people will say, all right, I want to focus on acquisitions and asset management, or I want to focus on capital raising. My personal opinion is if you're forming a partnership with everybody, with somebody, you both should be raising capital. It doesn't mean you need to be raising the most amount of capital, but that aligns interest better than anything, in my opinion.
No, I love that, man. And that actually makes a lot of sense. Obviously with the caveat of like, as long as they're not a total piece of shit, and I can say that because it's my podcast. You can, but as long as they're not, as long as they're not a total piece of shit and like actively looking to screw over their family members, their friends, their whatever, right? People they have personal relationships with. You're right. Because like, putting your own skin in the game, there's something to be said for having your money in the game. But like, I also hear what you're saying, and that's actually way more painful. Right? Like losing a friend's money for me would be infinitely more painful than losing my own.
Absolutely.
And I think that's true. I think that's true for like most entrepreneurs, to be honest.
Yes. You're not going to lose. I mean, for me personally, I won't lose sleep over like an investment that I made with my own money that I have nobody else involved with. But if I'm taking a single dollar from anybody, for me, that's what causes a lack of sleep, is if that deal goes bad. So I completely agree with you.
And the kind of the framework that you just provided right now is pretty similar to the way that like I hire new employees and hire, I used to run a real estate team. And so we, had a kind of a 3-part interview. And so the first part of the interview was like, just make sure they're not crazy, right? Just like make sure that they like have a pulse, can fog a mirror, and that they're not like batshit insane. The second part was the 3-year picture conversation. And so that's where we would kind of go over, what their next 3 years look like, what our next 3 years would look like, and see if those visions are in alignment. And it sounds like that's exactly what you were doing, right? Let's make sure that our visions are in alignment. 30 years is a long time out, but even making sure that like the next 5 to 10 years, our visions are in alignment, because truly one cycle, like that's a decade, that's 5 to 10 years. So you're right. Like if your visions aren't in alignment for at least one cycle, then you probably shouldn't get into a partnership with one, with someone. And then lastly, is the details, right? So like first we go over the visions, and then if at that point, like our visions are in alignment, then we can talk about, equity splits and, all that good stuff. But like until we make sure the visions are in alignment, then we shouldn't really move on to anything else. Sounds like that's exactly what you did, right? You make sure that we're in alignment, and then we kind of work out the details. And then lastly, you're also making sure like everyone has some sort of skin in the game, whether it be your own or your friends, family, everything. And ideally probably both, right? Like make sure you have a little bit of skin in the game, and you also have raised enough capital to kind of have other people that you care about's skin in the game.
Yep. And to be clear, the first partnership that I had, we did not do that, right? It was more like, we did maybe 5 out of the 20 boxes were checked, but I was so excited to just get deals done. And I think they were as well. And we didn't really think as much about the big picture. And, we're still working on deals together that we've bought and are currently managing. We're not doing new deals together just because the visions kind of went in a different direction. So luckily we're all still great friends. There's no, animosity or issues like that, but it was one of those kind of partnerships that didn't stand the test of time because we didn't do that work up front. Right. And I think in the end, it's going to work out for the best. Just in terms of, they're growing their business in one direction, we're growing our business in a different direction. And that's amazing. But yeah, I think it's easy to get really excited about, hey, I met this person. They compliment me in these ways. We can get together and do these deals together, that you just skip over X, Y, and Z, to just to get the deal done. So it's easy to fall into that.
Yeah, 100%. And I can see that in the same line of sight as, hey, don't do deals just to do deals. It's also like, hey, don't find a mentor, don't find a partner just to find a mentor or a partner. And I've seen other friends of mine get into bad partnerships before. Sounds like yours was a good partnership, but it's provided you with what you needed, right? Which is to start, you got some deals under your belt, and it kind of gave you the activation energy that you needed to keep going. And maybe that's cool. There's something to be said for that too. And something for listeners to learn as well is like, hey, maybe the next 10 years aren't in alignment, but like maybe we're in alignment for like our first couple of deals and then we move our separate ways, right? Like that's also a possibility, but that's also, it could potentially lead to some bigger issues down the road. But it sounds like you guys were able to or you guys are like doing awesome things and you kind of moved your separate ways, but you're still working on those projects together. So clearly you guys are still in good terms. We're running up on time, Kevin. Want to make sure that we are respectful here of your time, but had a couple last questions here for you. Things are changing right now in the investing space. I'm wondering what kind of changes you're seeing in real estate in general and what you're doing to prepare yourself for that.
Yeah. So I think starting from like the just business standpoint, going back to the utilizing tech standpoint, we're really big on just how do we keep the team as small as possible, but as efficient as possible. So we keep saying we want to be a small but mighty team, right? So how do we do that effectively? So that's a big thing for us, is just not being anti-technology because we're real estate people, but really focusing on what kind of like tech can we use. So one, we don't get passed over, and two, we can, make sure that we're running a great business. In terms of just like the market today, I mean, I think for us, we're trying to keep things as simple as possible. So where we've gotten into trouble in the past is where we overcomplicate, where we try to be too smart. I always say like, don't be smart, because when you start getting into interesting hedging strategies and using floating rate debt with this extension option, which we've done all that, and we can speak that language, you just introduce more opportunity for things to go wrong. So for us right now, it's all about like default aggressive on underwriting deals, but default conservative on actually pulling the trigger on those deals, and then keeping things as simple as possible and making sure we have the right team to actually execute on the business plan. So for example, if there's some very unique deal where if you can do some sort of strategy that will drive IRR an extra 10 points, but we don't have the capacity or the knowledge to do it, just because it could be a great deal, if we don't really believe that we can execute on it without distracting from other things, we're just not going to do it.
Love it, man. No, I think there's a lot there. And especially, kind of coming back to that technology piece, obviously things are changing very rapidly right now, and with technology and whatnot. And so it's interesting to hear you say that as well, because I think that even though we don't really fully understand how, things like AI are going to really impact investing, it's going to impact everything. But I think if we're like thinking about that and trying to stay ahead of it, that's going to really bode well for anyone that's able to kind of like adopt that technology sooner rather than later. Kevin, you've been awesome, man. And in traditional Gould Mine fashion, we're going to have you lead the audience with one final Gould nugget.
one final gold nugget. So basically just one piece of advice or thing I've learned to lead the audience with.
Precisely.
All right. I might need a second to think about that. I think my goal is a gold nugget, is what you call it, right?
Yep.
So I think my gold nugget for the audience would be just to have a eternal mindset, right? So whenever you're making decisions about things, if you're thinking about it as to like, how will this affect me in the next day or the next month or the next year, that's one perspective. But if you're thinking about it, all right, how will this affect me for like forever or for the long term? Like whether it's your legacy or, based on your spiritual beliefs, whatever, it gives you the right perspective to make a decision that's not rushed and that's not based on, making a quick buck or something like that. So I think like zooming out on these day-to-day decisions can help you really make good long-term decisions for your business, for your life, for your family. And it also helps you weed out the noise, right? Like oftentimes I know for me, I get so frustrated about things that are not going to matter in 10 years. You know what I mean? So when I have that like eternal mindset and that eternal perspective, I feel like I make better decisions. So that'd be my gold nugget.
Wise words from a young man. Kevin, you've been awesome, brother. Appreciate your time.
I appreciate being on, man. This was fun.
This was a lot of fun.